The CEO of Caesars just called this summer in Las Vegas difficult and soft, less than 24 hours after reporting a $55 million loss and flat revenues. For a company running 8 strip casinos, that's not just rare honesty, it's an admission that the Vegas boom may be cracking. But what forced this confession? And how deep does the crisis run? Tom Reeg, the chief executive of Caesars Entertainment, did not wait long to speak plainly. Less than a day after the company posted its third-quarter results, he addressed analysts and investors with a candor rarely heard at this level. Las Vegas had a very soft summer. Demand was difficult. The words landed with weight, not as a carefully crafted excuse, but as a direct acknowledgement of trouble at the heart of the Strip. For years, Reeg had pointed to steady crowds and strong bookings, even as other markets wobbled. But this time, the message was different. The softness he described was not limited to convention business or a blip in the calendar. It was rooted in the everyday choices of travelers, people who, for whatever reason, were staying home or spending less. The timing of Reeg's statement amplified its impact. With the ink barely dry on a quarterly loss and flat revenues, his admission left no room for spin. Analysts and financial media seized on the phrasing, highlighting its rarity and the urgency it carried for a company with 8 major Strip resorts. In the world of corporate earnings, such public candor is uncommon. Executives are trained to reassure, to point to future growth, to downplay setbacks. Here, though, Reeg's words served as a public signal. The Las Vegas boom was faltering, and the pain was not hidden behind closed doors. The confession set the stage for a deeper look at the numbers and the reality behind the neon. Caesars Entertainment's third-quarter results laid out the numbers in black and white. The company reported a net loss of $55 million for the third quarter of 2025, a sharp increase from the $9 million loss posted in the same period last year. Total net revenues came in at $2.869 billion, essentially flat compared to the prior year, despite inflation and higher operating costs across the industry. The company's same-store adjusted EBITDA, a key measure of operating profitability, landed at $884 million, down about 11% from the $995 million recorded in the third quarter of 2024. These headline figures tell the story of a company under pressure. The flat revenue line signals that growth has stalled, even as expenses continue to rise. The widening net loss reflects not only softer demand, but the impact of fixed costs that don't disappear when volumes dip. Adjusted EBITDA, which strips out some one-time items and non-cash expenses, is closely watched by analysts as an indicator of core business health. An 11% decline in this metric on a revenue base that did not grow signals that profitability is eroding faster than the top line suggests. For a company with a national footprint and a history of resilience, the combination of flat revenues and shrinking profits is a warning sign. The numbers serve as a direct counterpoint to the optimism that dominated earlier quarters. They also set the stage for a closer look at what's happening inside Caesars' most important market, Las Vegas. Las Vegas, once the engine of Caesars Entertainment's growth, delivered a jolt in the third quarter. Segment revenue for the Strip properties landed at $952 million, a drop of nearly 10% from the $1.06 billion posted a year earlier. The damage did not stop at the top line. Adjusted EBITDA, the company's preferred measure of operating profit, fell even harder, down almost 19% year over year, from $472 million to $379 million. These numbers are not abstract. They represent a sharp pullback in the cash flow that funds everything from capital projects to payroll. For a business built on high fixed costs, towering hotels, sprawling casinos, and thousands of employees, such declines quickly ripple through the financial statements. Every percentage point lost in revenue multiplies on the margin line, especially in Las Vegas, where the mix of rooms, gaming, and entertainment is finely tuned for profitability. The segment tables, stripped of narrative, show the reality: fewer dollars coming in, and even less left over after expenses. This is not a small market correction. The nearly $110 million drop in revenue and the $93 million hit to EBITDA in a single quarter underscore how sensitive the Strip is to even modest changes in visitor behavior. For Caesars' finance team, accustomed to steady flows from its 8 flagship resorts, the third quarter's results delivered a clear warning. The Strip's financial engine, for now, is sputtering. Operational cracks began to show in the details behind the headline numbers. Caesars management pointed to a clear drop in citywide visitation as the first domino. Fewer travelers meant fewer hands at the tables, fewer rooms filled, and less money flowing through every corner of the resorts. The casino floors felt the impact directly. Management cited an unusually poor table games hold, meaning guests won more than the house expected, a twist that cut into the core of gaming profits. Last year, table hold ran above average. This summer, the luck swung back toward the player, and the difference showed up immediately on the bottom line. Hotel operations faced their own set of challenges. Occupancy, which hovered near 97% in the summer of 2024, dropped to about 92% this year. For a Strip operator, a 5-point decline is not a rounding error. It means thousands of empty rooms each month. That lost volume isn't easily replaced, especially when paired with weakness in average daily rate. Caesars reported ADR down just over 6% year over year. Lower pricing power not only cuts into direct room revenue, but also drags down spending on food, drinks, and entertainment. Every guest brings less value across the property. These operational levers, visitation, table hold, occupancy, and room rates, moved in lockstep against Caesars this quarter. The company's own commentary made it clear this was not just a blip or a single bad weekend. The softness ran through the entire system, exposing how quickly margins can unravel when both guest counts and spending habits slip. For operations managers on the Strip, the summer of 2025 was a lesson in how fragile the math of Las Vegas can be. Trading opened with a jolt. Caesars stock plunged nearly 9% by the closing bell, erasing hundreds of millions in market value in a single session. At its lowest point, shares dipped more than 12% below the previous day's close, as heavy volume signaled broad investor retreat. Analysts cited the CEO's blunt warning and the sharp drop in Las Vegas profits as the driving forces behind the sell-off. The market's reaction was swift and unforgiving, a clear message that Wall Street was rattled by the prospect of prolonged weakness on the Strip. For investors, the red screens told their own story. Brett Juncker, Caesars' chief financial officer, responded to the market's sell-off with a familiar message. On the earnings call and in interviews, he described the company's shares as undervalued, pointing to ongoing stock buybacks and continued efforts to reduce debt. Juncker emphasized that these capital moves reflect management's confidence in Caesars' long-term prospects. Even as the numbers told a different story for the summer, the reassurance was clear. Leadership believes the market reaction has overshot the company's true value. But with table games, hotel occupancy, and room rates all trending lower, the defense landed amid growing skepticism from analysts and investors alike. Outside Las Vegas, Caesars' regional casinos posted revenue growth of 6.2% year over year, offering a rare boost amid the company's broader struggles. Digital gaming volumes also held strong, even as September's sports betting returns fell short. These results suggest resilience in markets beyond the Strip, but raise questions about how much longer regional strength can offset weakness at the core. In the third quarter of 2025, Caesars Entertainment reported a $55 million net loss, with Las Vegas revenues dropping nearly 10% to $952 million and adjusted EBITDA falling almost 19%. CEO Tom Reeg's on-record statement, calling it a difficult, soft summer, marked a rare public admission of weakness in leisure demand on the Strip. The company's 8 major Las Vegas resorts saw lower occupancy and average daily rates, reflecting fewer travelers and reduced spending power. Within 24 hours of this disclosure, Caesars' stock price fell sharply, underscoring how quickly investor sentiment shifted. While regional properties grew 6.2% year-over-year and digital volumes held steady, Las Vegas remains the brand's financial and emotional core. Management claims the downturn is temporary, but the evidence shows a clear vulnerability. What remains unknown is how soon consumer demand will recover and whether citywide visitation will rebound. For now, the numbers confirm a simple fact. Even Las Vegas is not immune to broader economic pressures.